Picture this. November 1923. You're standing in a Berlin bakery, and the price board behind the counter reads 200 billion marks for a single loaf of bread. Not 200 marks, not 200,000, 200 billion. The woman ahead of you pulls out a wheelbarrow, not to carry groceries, but to carry enough cash to pay for milk. By the time you reach the front of the line, the baker crosses out the price and writes 250 billion. The mark lost 30% of its value while you stood in line for 12 minutes. This isn't dystopian fiction. This was the Weimar Republic, and it's happened again and again. Venezuela, 2018. A carton of eggs cost 7 million believers. Zimbabwe, 2008. A bus ticket required a $100 trillion banknote. Lebanon, 2023. The currency lost 98% of its value in 4 years, turning doctors into paupers overnight. Here's the thing that keeps me up at night. It's not if your currency will fail. Historically, it's when. The average lifespan of a fiat currency is 27 years. The dollar's been around since 1971. Do the math. So here's the question that actually matters. When the rules of money are rewritten overnight, what holds value? I went through a century of economic autopsies, from Weimar to Venezuela to Lebanon to Zimbabwe, and pulled the financial forensics. Not theory, not speculation, historical fact. By the end of this video, you'll know exactly which 5 assets survived when empires burned, and which ones evaporated faster than a currency in hyperinflation. Stick with me. Before we dive in, understand this. Currency collapse follows a pattern. It's mathematical, predictable. Stage 1. The government spends more than it collects. Stage 2. It prints money to cover the gap. Stage 3. The currency starts losing purchasing power. Stage 4. People flee to alternatives. Stage 5. Complete collapse. Every single time. Weimar Germany went from 320 marks per dollar in mid-1922 to 4.2 trillion marks per dollar by November 1923. That's a 98% loss in 18 months. Venezuela's bolivar went from 10 per dollar to over 1 million per dollar in a decade. Lebanon's pound collapsed from 1,500 per dollar to 89,000 in 4 years. Same pattern, same stages, same outcome. So what survived? Let me show you. Number 1 is the most obvious, and yet it's the one most people still don't own. Precious metals, gold, silver. The assets governments can't print and central banks can't debase. Here's the brutal math. During the Weimar collapse, if you held paper marks, you lost everything. 100%. Total wipeout. If you held gold, you maintained purchasing power entirely. An ounce of gold bought you the same basket of goods before, during and after the hyperinflation. The currency changed. Gold didn't. Same pattern in Zimbabwe. When Mugabe's regime printed the $100 trillion note, anyone holding gold was protected. Same in Venezuela. While bolivares became worthless, gold retained value. And we're seeing it right now in Turkey. Late 2024, data shows gold deposit accounts at Turkish banks surged from 1.36 trillion liras to 2.72 trillion liras in a single quarter. That's a doubling in 3 months. Why? Because Turks see the pattern. Runaway inflation, currency debasement, and they're fleeing to the only asset that's survived every collapse in human history. Here's what gold critics miss. Gold doesn't need to do anything. It doesn't need earnings. It doesn't need dividends. Its entire function is to not be debased. When the supply of fiat currency explodes, the purchasing power of each unit collapses. Gold's supply can't be arbitrarily expanded, so it becomes relatively more valuable by default. During the 2008 financial crisis, gold crashed initially, fell hard as liquidity froze. But once the dust settled, it rose 166% in less than 3 years. Silver did even better, 448%. During the 1970s stagflation, gold fell almost 50% mid-decade, then bottomed in 1976 and surged 440% over the next 3 years. Pattern recognition. Verified. Undeniable. The mechanism is brutally simple. Precious metals are insurance against monetary system failure. Not speculation. Insurance. You hold them because they do nothing except preserve purchasing power when everything else burns. Number 2. Foreign hard currencies. When your domestic currency is dying, the escape valve is holding someone else's stable money. Let me take you to Beirut, October 2019. You're a nurse. You've saved $50,000 in your bank account over a decade of work. The Lebanese pound is pegged at 507 per dollar, has been since 1997. Rock solid for 22 years. Then the peg breaks. August 2019, black market rate hits 1,600. April 2020, 3,000. March 2021, 14,000. By 2025, the official rate is £89,000 per dollar. Your $50,000 in pound-denominated savings? Now worth $1,000. You lost 98% of your purchasing power while the nominal number in your account stayed the same. But here's the kicker. Your colleague, another nurse, kept her savings in US dollars, physically in cash, outside the banking system. She maintained 100% of her purchasing power. Not because the dollar was magical, she could have used Swiss francs or euros, but because she held a currency that wasn't collapsing. This pattern repeats everywhere. Zimbabwe. The economy dollarized itself before the government made it official. People abandoned the Zimbabwe dollar entirely and started using US dollars for transactions. Ecuador did the same in 2000 after a financial crisis. El Salvador in 2001. Panama's been dollarized since 1904. Venezuela right now. Venezuelans use dollars for major purchases even though the bolívar is still technically legal tender. Argentina. You buy property in dollars, not pesos. Cambodia. ATMs dispense US dollars, not reals. This isn't a policy choice. It's a survival mechanism. When domestic currency fails, rational people switch to stable foreign currency. The government can mandate all it wants. People vote with their wallets. The lesson is clear. Access to foreign currency during a crisis is complete protection. A person holding dollars during the Lebanese collapse maintained their wealth. A person holding pounds lost 98%. That's not market volatility. That's the difference between survival and annihilation. Number 3 is counterintuitive, and it separates people who understand currency collapse from those who don't. Productive equities, stocks, ownership in real companies with real assets. Here's what blows people's minds. Venezuela's stock market rose over 3,400% in 2024. The Caracas Stock Exchange surged from 2,082 points to over 6,000 in 9 trading days in January 2026. Individual stocks went parabolic. Mercantil Servicios Financieros up 200%, CanTV up 219%, Banco Provincial up 171%. You might think, wait, the economy's collapsing and stocks are skyrocketing. That makes no sense. Wrong. It makes perfect sense once you understand what stocks are. A stock isn't a piece of paper. It's ownership in real assets, factories, equipment, inventory, land. When currency collapses, the nominal price of those assets rises to match inflation because the assets themselves haven't disappeared. Imagine a Venezuelan manufacturing company worth $100 million in real productive capacity. When the exchange rate goes from 10 bolivars per dollar to 30 bolivars per dollar, the stock price rises from 1 trillion bolivars to 3 trillion bolivars, not because the company got more valuable, but because it takes more bolivars to equal the same dollar amount. But here's the critical distinction most people miss. Not all stocks survive equally. Only companies with revenue streams diversified away from the collapsing economy maintain real value. A company earning 100% of revenue in bolivars sees its real profitability collapse even as its nominal stock price rises, because it has to convert worthless bolivars back to dollars to buy foreign inputs. Conversely, a company that exports 50% of production receives dollar revenues directly. Its bolivar costs decline in real terms while dollar revenues stay stable. Real profitability improves during devaluation. For shareholders, this becomes an actual inflation hedge. Research on the Latin American crisis of 1982, Mexico's peso crisis of 1994, and Asia's meltdown of 1998 confirms this. Direct investors operating manufacturing facilities that could redirect sales from local markets to export markets survived and thrived. Other investment forms plummeted into negative territory. The key was export capability. So the lesson: productive equities with international revenue streams are not just survivors, they're beneficiaries of currency collapse. But domestic-only companies, they burn with the currency. Quick pause. If you're realizing that everything you thought you knew about economic safety is wrong, hit that subscribe button. This channel is Financial Forensics. I show you the autopsies so you see the patterns before they repeat. It's free, unlike financial literacy and a system designed to keep you ignorant. Now, back to the assets that survive when money dies. Number 4. Consumables and barter goods. When the formal monetary system fails completely, economic activity doesn't stop. It reorganizes around different media of exchange. Post-World War II Germany, the Reichsmark was so worthless that it was effectively abandoned. People traded goods for cigarettes, coal, potatoes. Cigarettes became particularly prominent as a temporary currency. American soldiers bought cigarettes from army exchange stores for pennies and traded them with Germans for goods and services worth exponentially more. Why cigarettes? Standardized cartons, easily divisible, non-perishable, light, widely accepted. They had all the properties of money except one: a government didn't issue them. Black markets near train stations in big German cities operated 24/7, trading everything from railway tickets to forged documents, with cigarettes as the medium of exchange. Here's the economic proof. When large backlogs of Red Cross packages arrived at POW camps, sometimes injecting hundreds of thousands of cigarettes into the camp's money supply at once, it caused inflation in cigarette prices. Same mechanism as fiat currency expansion. More cigarettes chasing the same goods equals higher cigarette prices. Fast forward to Venezuela 2018. As the bolivar became worthless, Venezuelans engaged in barter. Fishermen traded their catch for flour just to feed their kids. Items that held value: medical supplies, food, water, fuel, batteries, lighter fluid, basic tools, anything with immediate consumption value or enabling essential functions. During supply chain disruptions, even toilet paper, soap, and wet wipes became valuable, not for comfort, but for health. Staying clean prevented infection spread during systemic failure. But here's the limitation: consumables are consumed. They can't serve as long-term stores of value. You can't build a portfolio on aspirin and batteries. They're tactical, not strategic. The optimal allocation: a small portion in physical necessities for immediate exchange value during acute crisis phases, but the bulk of wealth in assets that don't evaporate when used. Number 5. Agricultural land. The immobile store of value that produces the one thing humans can't live without: food. During the Great Depression, farmers had survival advantages over urban dwellers that were stark and undeniable. Farm families raised gardens, canned fruit from orchards, had milk and cream from dairy cattle, chickens for meat and eggs. They could do without new clothing and consumer goods, but they faced one brutal constraint: they still had to pay taxes and debts to banks and cash. This dynamic plays out in every modern collapse. Venezuela. Those owning agricultural land maintained capacity to produce food regardless of currency fluctuations. Those owning urban commercial real estate faced tenants who couldn't pay rent in any meaningful terms. Land produces calories. Urban real estate produces rent denominated in collapsing currency. Calories win. But, and this is critical, agricultural land has severe vulnerabilities. First, it's utterly illiquid. You cannot move it. You cannot quickly sell it. If political circumstances deteriorate and ownership becomes unsafe, you're stuck. Zimbabwe, 2000. Mugabe's land seizure program simply revoked commercial farmers' property rights by decree. Farms were redistributed without compensation. Sophisticated operations were destroyed. Agricultural output collapsed 60% over a decade. The farm's aggregate value declined by 75% between 2000 and 2001 alone. Second vulnerability: taxation. A person holding urban commercial real estate in a collapsing currency may be forced to sell at a fraction of previous value just to raise cash for property taxes. Land cannot hide. Governments know where it is and can tax it into oblivion. Third, agricultural land that produces export crops is superior to land producing only for domestic consumption. Export crops sell for stable currency. Domestic crops sell for collapsing local currency. So the strategy: own land that's either productive and capable of generating export revenue, located outside the jurisdiction of the collapsing currency, or held through a corporate structure that protects against seizure or direct taxation. Agricultural land maintains fundamental value through its capacity to produce food, but it's less liquid and more vulnerable to government interference than precious metals or portable equities. Now let's talk about what goes to zero, because understanding what fails is just as important as knowing what survives. Number 1 with a bullet: fixed income securities denominated in the collapsing currency. Bonds, treasury notes, Anything where you're a creditor to a failing state. Weimar Germany. Bondholders who held government bonds in marks saw their investment become worthless as the marks used to pay interest and principal evaporated. Argentina, 2001. Bondholders saw nominal value cut by 70% in debt restructuring. Even this reduced value could only be collected after years of legal disputes. The fundamental problem: fixed income securities are a claim against the collapsing currency itself. When the currency collapses, the claim becomes worthless. This isn't market failure, this is logical consequence. Number 2. Savings accounts in domestic currency held within failing banking systems. Lebanese deposits denominated in pounds lost more than 95% of value, as the pound devalued from 1,500 per dollar to 89,000 per dollar by 2025. Bank customers who placed savings in pound deposits in 2019 retained 2% of original purchasing power by 2024. The nominal amount stayed the same. The value disappeared. History is unambiguous. Being a creditor to a failing state is the fastest route to 100% wealth destruction. So where are we seeing these warning signs right now? Because pattern recognition only matters if you can identify the setup before it executes. Iraq, financial crisis due to lack of cash liquidity. More than 70% of monetary supply is diminished due to banking restrictions on withdrawals. The dinar devalued from 190 per dollar to unofficial rates approaching 1,750. Public distrust of banks. Currency smuggling across borders. This is stage 3 behavior. Turkey. Gold deposit accounts more than doubled in a single quarter as citizens fled to precious metals. Runaway inflation. Currency debasement. This is stage 4 behavior. Currency substitution has begun. Lebanon. 98% currency collapse already executed. Banking system technically insolvent. This is stage 5. Complete failure. And then there's the elephant in the room, the United States. $38 trillion in debt. Debt to GDP ratio expanding unsustainably. Interest payments on national debt now higher than military spending. The dollar's share of global foreign exchange reserves has fallen from 80% in the mid-1970s to 65% now. Same path Britain's sterling travelled during its decline as the world's reserve currency. In 1913, Britain was the world's biggest creditor. Within 40 years, it became a net debtor, and the dollar replaced sterling. The pattern is visible if you're willing to look. So here's the brutal truth. Currency collapse isn't hypothetical, it's historical norm. The average fiat currency lasts 27 years. 99% of all currencies that have ever existed no longer exist. The question isn't if your currency will fail. The question is whether you'll have positioned yourself to survive when it does. The 5 assets that survived every collapse since 1923. 1. Precious metals, the universal store of value. 2. Foreign hard currencies, the escape valve. 3. Productive equities with export revenue, the beneficiaries of devaluation. 4. Consumables and barter goods, tactical liquidity when systems freeze. 5.